Investing. Investing is something that most of us do in the United States, whether we know it or not. If you have a bank account, that's actually a minor form of investment. Today we're going to be talking about time and its effect on investing. What we mean by that is simply what factor does time play in investing? So it can be a simple thing. You can, if you have any experience in owning any kind of loan, I mean, a loan is the other side of the investment, right? When you borrow money, somebody is, in a way, investing in you. You're making an investment that you will repay them in the future, and they want to get something back. And as you probably know, the longer the term of a loan, generally speaking, the more you have to pay in interest, in annual fees, essentially. So why is that? Well, you would expect that the longer you allow someone to borrow your money, the longer you're willing to not demand payment, the more your return should be. And that, in general, is a very true idea, And when we look at common instruments in the market, you have very short-term interest. They have, overnight deposits. They have, 1 day, 5 day, 1 month, 3 month. You can get CDs, right? 1 month CD, 3 month CDs. So those kind of instruments you should expect to get less from. Just like if you were to borrow money from the bank or something, if you took a 3 month loan, they would probably charge you a much lower interest rate than they would for a 30-year loan. So, and almost every time, I don't know of a situation where a 15-year mortgage was less than a 30-year mortgage. As far as, it was more than a 30-year mortgage in terms of interest rate. So a fairly easy concept to understand. So what security out there has the longest life? What investment vehicle? Well, generally speaking, it's stocks, right? Stocks, generally speaking, they don't expire. Now, in reality, that's not the case, right? Companies go out of business, companies get bought. And so in those cases, there's certainly a end of life, and there's certainly no guarantee that any company won't at some point either be bought out or go bankrupt. So, but it's indeterminate, right? It's indeterminate when those companies' end will be. So when you invest in something like stocks, you should demand a higher rate of return. But as we have discussed in the past, that's up to the investor to figure out, am I getting the requisite return? We talked about risk essentially in the market, and making sure that you are getting paid the requisite return based on that risk. Well, for time as well, you have to look at it and see if you're getting the requisite return. Now, things are not always so simple. I have this up from the Wall Street Journal just to sort of illustrate, this is the current interest rates for 1 to 10 year maturities is 5.175% for corporate debt, and basically 5% for 10 plus years. So you can see right now there is just a small difference, at least in corporate debt. Now, interestingly enough, this happens to be a time in the world, a time in the United States at least, where interest rates are at the highest they've been in quite some time. Now, historically, 4% for the US 10 years is not historically a high number. It's only in recent history that's a high number. But that's where we're at, and currently we have this, what we call an inverted yield curve, where you can actually make more on a percentage basis in return by investing in shorter term government bonds, treasuries, government securities, essentially. I mean, you have way out here at the 30-year. If you want to lend the government money, the U.S. government money, you're only going to get 4.371%. But if you're willing to shorten that up, at the highest, we're talking 3 month. So what does that mean? I'm sorry, I'm blind. The 2 month. So what does that mean? So that means that, yes, if you're just looking at the rate of return, the 30-year is much, much worse than the U.S. 2 month. But what investors have decided, and look, and there's some reasons why something like the 30-year, which isn't traded nearly as much as, say, the 10-year, would be so different. But what we're seeing here is that, yes, for the next month, you can get this 5.382 return. But over a 30-year period or a 10-year period, these investors believe that buying at 4.139% now will give them a longer and a higher return over the long run. So yes, you might earn your 5.382%, the equivalent for a 1 month return. Now, of course, that's a year's return and not for 1 month. So you're talking about getting approximately a 12th of this amount. So yeah, that's something. But one, people who buy short-term treasuries like this are usually a different class of people than people who are buying this. So, they're not the same sort of people. I mean, they're not the same investors. They don't have the same goals. One. And two, even if they did have the same goals, there's logical reasons why somebody would be willing to only get 4.139% in the short run, because they believe in the long run, eventually these numbers will come down sufficiently enough. Now, you got to remember, there's enough people in the market that believe that this is the case, that these numbers will come down sufficiently enough that this 4.39% will be greater than all of these others that have lower maturities, time to maturity. So think about that. Think about what that means to the economy. That's the case, that they believe that all of these interest rates will go down. Because that's, the market is telling you something. The people in the market are telling you something when this is the case. Because we're talking about billions and billions of dollars. Think about how much U.S. government debt there is. I think we're well over 20 trillion. It might be 25 trillion now. I mean, and they break it up into these different chunks. When you break it up, this isn't some, a thing like, what's that, GameStop, where there's a few traders out there manipulating the market. This is trillions and trillions of dollars. These are governments and huge mutual funds, retirement accounts, 401k, people who invest in 401ks. I mean, this is what we're talking about here. Just sophisticated investors have created this, and they are telling everybody in the market that right now the 10-year is a good deal or a fair deal. How about that? At 4.139%, even though the 2 month is higher at 5.4%. So, think about that and the implications of that may be the case. So, they're really truly believing, of course, that if they are wrong, if these stay here, then they're better off, obviously, just leaving it in there, right? Just rolling it over, just keep rolling it over. And in 30 years, instead of earning 4.1, or 10 years, 4.139%, they're going to earn 5.394%, right? So, there's some implications to this. That's why you got to kind of pay attention that something fanciful is occurring in the market now. So, sometimes this means that a depression, recession sort of situation is occurring. Not necessarily so. There's a lot of moving parts in the economy, but just be aware that this is unusual. This is something that you need to be aware of. But, I talked about, different people or different kinds of people looking at different, what we call, horizons. Yes, you might have some expenses that are occurring down here as an individual, and you might have some down here. So you might be some way interested in all parts of the market, right? So, understanding how these affects, your individual investments is important. So, but that's kind of what you need to do as an investor. Decide how much money do I need in the short term, medium term, and the long term, and then invest appropriately. Like if you need money in the next year, 2 years, investing in the stock market is probably not the way to go. Yes, you can come out ahead. On average, you will come out ahead, but the degree to which you need that money, if your kid was going to school in 2 years and you needed exactly $100,000 and you had $90,000, and you could not have one penny less, maybe they would kick your kid out of school. They wouldn't allow them to attend unless they had the whole amount. Let's make up some terrible scenario. But if you felt you absolutely needed that amount, well then, maybe you invest in a 2-year treasury and you earn, you earn $3,600 the first year and then another $4,000 or the second year, and you make up the difference by working hard. If you 100% needed it, that's what you would do if your life was on the line, right? You could do that and pretty much assure yourself that you're going to have 100,000. Now, if you're willing to take a little bit of risk, maybe you go into corporates. What's the 10? The two. We got. Let's do 10 years. 4.39. Let's say it was 10 years away. You could do that. Well, you have these 10-year maturities. If you're willing to go corporate, now it's 5.489%. So you're getting a full 1.3% a year, which, look, it's not a ton of money, but it's more. So if you had 100,000, easy math, you're talking an extra $1,300 a year. After 10 years, with some compounding, you're close to $15,000. So who wouldn't want to have an extra $15,000? Well, if you absolutely needed just the 100 or the 108, 109, and you couldn't afford to try to make it up if you fell short, well, yeah. Those are the kinds of things you have to consider. And of course, you get down here into your high yield bonds, your so-called junk bonds. Now you're up to 7.75%. So you're talking about a much greater return, but now you're taking on risk. That's what we're not talking about. So, think about your investment horizon and how that's going to play into what you invest in, because it matters. It matters. And what happens, there's some simple equations, and you can think of it this way, if interest rates change because of the economy, interest rates change for whatever reason, up or down, the longer the maturity of your security, and like we said, stocks is the longest maturity, it's infinite. But practically speaking, it's not infinite, but for our terms, it's essentially infinite. A small effect here is going to ripple through until the end. Now, yes, we have discount models and things like that in the equations, but yeah, you can see it, right, without doing the math. What's it matter if you're in a 1 month bond that's going to pay you 5% divided by 12, right? Because it's 5. If the market suddenly turns and now interest rates are 10%, well, the effect on that 1 month bond, 1 month bill, whatever, is not great. It's still essentially worth whatever you paid for it, minus a little bit. But if you held on to it, you're still going to get your 5%. Oh, no, sorry, your 5% divided by 12. But now if you had a 30-year bond, and the ripple effect, because now everything is going to be discounted. All those future payments, those 30 years of payments, are going to be discounted into the price. Does that affect the fact that you will still get the same exact money if you hold on to it? No, it doesn't affect that. But the value, what they call the present value of that bond, is going to be greatly reduced if it was at 5 and now, if the going rate was 5 and now the going rate is 10%. So think about these things. Think about your time horizons. Yes, generally speaking, over the long haul, stocks are going to pay you more if you have the patience to actually handle it. Because like the bonds, the stock valuation might be the same as far as what they think the price of the stock is going to be in 10 years or 20 years, right? Maybe it's at $100 today, and they think in 20 years it's going to be $500. And whatever the rate of return is required for that is, if suddenly it's decided, maybe because interest rates go up, that the rate of return is greater, well, now that really is going to affect stocks, right? It should affect stocks even more than it does bonds because of the length of the maturity of the security. But anyways, we had to just short talk today. If you have any questions about time and investing, please feel free to ask. It's an incredible topic, actually, but we can only touch on some of these things because the study of these things goes on. It goes on and on and on. The idea of an inverted yield curve was fantastical 30 years ago. Now it's somewhat commonplace. It's not that big a deal. But now it's like, whatever. These things happen. And you do the math and you say, you still come out ahead if these things happen, and we think these things are going to happen. So we've only touched on it. Maybe we'll touch on it again in the near future. If there's any questions, we'll try to answer them in the next podcast. Thank you so much for watching.